I want to move on and show you another ETF that you run. This one's not a CTA, but it's a hedge fund ETF. It's hedge strategy ETF. The symbol is DBEH, and that models the performance of 40 long-short equity hedge funds. So this is long-short equity hedge funds. This is different than CTAs, and it uses futures contracts. Now, explain how this works. We put a screen up here that shows you a little bit.
Yeah. So our insight into when you talk about this category, it's called equity long-short, and the idea is really smart guys are going to know not just what stocks to buy, but what stocks to short, which means bet it's going to go down, right? And so you're giving them basically two swords as when they go into battle. Our conclusion was that most of what they get right are big shifts in the market. They get off the tracks as the train is coming down. Mm-hmm. They shift into, when interest rates start to go up, they shift from FANG stocks that are dependent upon low interest rates to more interesting value stocks, or vice versa. They go into emerging markets at the right time. And so what we do is we look at, again, a large pool of funds. We're not trying to tell you whether they own Meta versus Alibaba versus Cemex or anything else. Rather, what we're saying is, let's get those big factor shifts right. They're called factor shifts. And if we get that right and put it into an ETF, we've given an allocator a really valuable tool because it's less risky than equities, but can generate equity-like returns over time.
This is the same strategy as the first fund that we talked about, which is you're aggregating models, essentially, right? So, on aggregate, if this pool is long, these 40 hedge funds are long Apple 3%, you're going to try to emulate that, right?
Absolutely, except we don't do it with Apple.
Right.
We would do it with a futures contract on NASDAQ. Yeah. And again, our entire business, the only way we found to do this well, and by this I mean get the diversification benefits.
Well, 40's a lot. 40's a lot. That's right.
But,
that's good.
But how do you get the diversification benefits of those 40 hedge funds that you cannot otherwise access, but in an ETF with trading efficiency and all these other features, is to figure out their big trades and copy them.
When you say you're using a NASDAQ future, you wouldn't be individual stock futures. You're talking about
overall NASDAQ, right? So if we see them in FANG stocks, for us that's a NASDAQ futures contract. It's not a series of individual stocks.
Okay. Yeah. All right.
Big trades.
Yeah. So. And explain what the cost is for this too.
Also 85 basis points.
Same cost structure overall as them as well.
Right, and so what we're trying to do is there are thousands of guys out there who run ETF model portfolios, which means stocks, bonds, and other stuff.
But they're not short.
Well, what we're trying to basically say is look, going forward in the 2020s, you have a different need, right?
Yeah.
60-40 and being long stocks and bonds entirely did incredibly well for a decade or more. It's a different world right now.
Correct.
And so we're trying to give you the building blocks where you can say, I want this much in this strategy, I want that much in that strategy, and it's as simple as investing in an S&P 500 ETF.
Yeah.
That's what we're trying to do.